Good morning. Last week we talked about the investment process, and one of the steps in the investment process after you've done your asset allocation is to decide what types of investments you're going to select for each asset class. So you're ideally going to have a diversified portfolio that includes different types of stocks, different types of bonds, perhaps some alternative investments like real estate, and you need to decide which investments to buy. The easiest and most effective in most cases way to do that is to invest through pooled investment vehicles, such as mutual funds and exchange traded funds, which are a variety of mutual funds but have a specific type of creation and redemption process that actually gives them a few benefits that mutual funds don't necessarily offer. And that's the subject of today. So we've had a busy week, actually a busy 5 weeks in the market. The market's been down 5 weeks in a row. This week was one of the worst weeks in particular for technology stocks, not just the level of oil prices, but Meta lost a major lawsuit, which caused about an 8% correction during the week in that stock alone. The subject today is mutual funds and ETFs. As I mentioned last week, there are actually more mutual funds and ETFs than there are individual stocks. They are basically pooled investment vehicles, and you can pool different investments in them. And so there's pretty much any investment strategy that you want to follow. There's a mutual fund or ETF that will do that for you, so you don't have to go out and pick the individual securities like stocks and bonds. So we're going to talk about the advantages and disadvantages of investing in these types of vehicles. And when I use the term mutual funds, I'll typically be talking about generically. That includes ETFs. ETFs are exchange traded funds, so they are a type of a mutual fund, but they are traded on an exchange, so they work a little bit differently mechanically. We're going to talk about how to calculate returns on mutual funds. We're going to look at how to classify them, and then we're going to look at what are the criteria that you want to look at when you're evaluating which of the funds to buy, because for any investment strategy, there's actually multiple funds that you can buy. Some are going to be better than others, and we'll talk about what are the criteria that you would use in selecting those. So as I mentioned, a mutual fund is a pooled investment vehicle. Instead of you buying investments directly, you're going to own them indirectly. You're going to put your money into an investment fund, and then that fund is going to have a manager who is in turn going to take your money along with everyone else's money and buy a typically diversified portfolio of investments. There are some ETFs today that are not diversified, where they may be investing in a single stock using a particular strategy. But for the most part, most mutual funds and ETFs are a very diversified portfolio. So when you own a share of one of these funds, you have a proportionate share of all of the investments. So I showed you last week VOO, which is a Vanguard ETF that follows the S&P 500. If you own 100 shares of that fund, effectively 7.5% of your investment is invested in Apple stock, because that's the largest holding in that fund. So you own a piece of 500 companies by owning that fund. So you have a diversified portfolio. It's professionally managed. Now, in that particular case, there's not a lot of management involved. They buy all 500 stocks. They only sell something if it drops out of the S&P 500. They only buy something new if it enters, but there is a professional manager that's doing all of the transactions. They're managing the investments. They're looking over them. They're deciding when they do need to buy and sell. They're deciding when to make distributions to you. If you want to get your money out, then they're handling all of that administration. So you're going to be paying a fee for them to do all of that. Every mutual fund is going to have to file registration documents with the Securities and Exchange Commission, as well as follow the guidelines of the stock exchange if they're an ETF. And one of the things they have to do is state their investment objectives. And so one of the things you're going to look at is, what is it you're trying to accomplish for your portfolio, and does that fund meet your objectives? If the securities go up in value, then the value of your shares goes up. If the securities go down in value, the value of your securities goes down. If the stocks and bonds within the fund are paying dividends and interest, then the manager is going to take those and distribute them to you periodically. So you're going to receive dividends or interest from your mutual fund investment, just like if you were buying the underlying investments directly. If the fund sells a stock and has a gain or a loss on it, that's also going to get passed through to you. The way that mutual funds and ETFs work is they don't have to pay taxes at the fund level, but the owners have to pay taxes on their share of the income. So that's why they distribute interest and dividends and capital gains to the individual mutual fund holders, and they're the ones that are going to report that income on their tax return. So why invest in mutual funds? You get pretty much instant diversification in most cases. You get professional management. It's typically a very minimal transaction cost. There are some funds that have higher fees than others, but for the most part, it's cheaper to buy and sell and manage those securities through a mutual fund because they're spreading those costs over many investors. You're not bearing them all yourself. Mutual funds and ETFs are very liquid. In the case of mutual funds, you can typically get your money out within a day or two. It used to take weeks, but these days, in most cases, you put your order in if you want to buy or sell a mutual fund during the day, and then at 4 p.m. they determine what's called the net asset value of the fund, and that's the price that you buy and sell the mutual fund from the mutual fund company. In the case of an ETF, you can actually sell it throughout the day. So the stock exchange in the US is open from 9:30 till 4 p.m. Anytime during the day, you can place an order to buy or sell shares in an ETF. That's why we call it an exchange traded fund. There's a lot of flexibility. You can get in and out of investments very quickly with one trade versus selling 500 individual stocks or buying 500 individual stocks. They're going to take care of servicing it. They're going to give you reports on how things are going. They're going to make the distributions to you. They're going to give you the information you need at the end of the year to file your tax return. While your book lists this as advantage, I'm going to keep it in. It's not so much of a problem these days, but many years ago, the way that most people invested was through a stockbroker who made their money on commissions, and commissions were at a fairly high level. So it might cost you $100 or close to $100 to buy 100 shares of stock, and there were brokers out there that would cold call people on the phone and get them to buy stocks just so they could earn a commission, even if it wasn't a particularly good investment. You avoid that by investing in a mutual fund. Theoretically, you could have a bad mutual fund manager, and there are mutual funds that charge commissions. We call those load funds. These days, there's very little reason to ever buy a load fund. So you can typically avoid things like commissions these days, investing in mutual funds and ETFs. Disadvantages. So a lot of people will tell you that if you look at the actual returns that mutual funds generate, they're actually lower than the index returns. And that is somewhat true, but it's to be expected. In some cases, there are some managers that aren't particularly good and their performance is much lower than the market index, but we actually should expect to not get the market index returns. And I've got some slides that I'm going to show you in just a minute after this one that'll show that. But if you think about it, an index like the S&P 500 is something that a financial services news company puts together, like the S&P 500. They basically look at the prices of those 500 stocks. They look at the dividends they're paying, and they create an index that measures the returns on those stocks. But in an index, they're not considering the cost of investing. So they're not considering the bid-ask spread, or if there are commissions or exchange fees that are being paid. The index does not consider expenses. So after expenses, you should expect you're not going to get exactly what the index does. Hopefully, you're going to get something that's pretty close. And we'll show you a couple of examples of ETFs and mutual funds later that perform very, very closely to their index. There are some funds, though, that have much higher expenses, and therefore, after expenses, you're going to get much less than the market index. So there are funds out there that might charge you a fee of 1.5% or 2% per year to manage those, and those are fairly high. As a result, you should expect that you're going to get 1.5% or 2% less than what the index returns. In the most cases I mentioned, mutual funds are diversified, but there are today some concentrated funds. There are mutual funds, I showed you one yesterday, that invest in only 30 stocks. Well, that's going to have more risk. So remember the curve. The more individual stocks you have, the lower your overall risk. But there's always a minimum level of risk that all funds are going to have. But if you have a concentrated portfolio that's in 30 stocks or less, then there's going to be higher risk than in a more diversified fund. So there are still risks involved. You can't diversify away the market risk. If the market crashes, everything is going to go down. And for the most part, the market's down close to 6% as of this past Friday. For the most part, not everything is down, but most stocks are down to some extent, some more than others. Now, one disadvantage to mutual funds in particular, not ETFs though, is that taxes can be high depending upon the type of fund. So, well, even some ETFs. So, for example, we talked about real estate investment trust, which are similar to mutual funds and ETFs. They are also a tax vehicle. They're investing in operating real estate. They might own hotels. They might own restaurant properties. They might own office buildings that are collecting rent. Well, the rules for real estate investment trust are that they have to distribute all of that operating income every year so that they don't have to pay taxes. And then the taxes are paid by the owners of those trusts. As a result, that's taxed as ordinary income to the owners. And so they're going to have a high distribution every year, but they're also going to have high taxes paid at ordinary income tax rates. The other disadvantage to a mutual fund from a tax standpoint is that if some investors decide they want to get their money out, the mutual fund manager has to sell some of the securities, which may generate a gain that then is passed through to all investors, not just the investor who's leaving the fund. So taxes can be high, but on the other hand, they can also be quite low. If you invest in an S&P 500 index fund or another very broad index fund, and you hold it for 20 years, you're going to defer taxes on that because you're not going to sell it for many years. And so you can also manage that to some extent. So let me show you an example of why we should not expect that on average, all of the mutual funds are going to outperform the market. It's not possible. So let's say we have a simple world. There's a total of $100 billion of investable assets, stocks, bonds, everything. There's two portfolios, and each of them manages half of that $100 billion, so $50 billion each. We call that assets under management. They both invest in the same asset classes, the same allocation between the different securities. And let's assume they don't have any expenses for trading. Let's assume that they don't charge you any fees for managing the money, just to keep it simple. And let's say that one of those managers earns 8%, and the other manager earns 12%. So while they're investing in the same types of assets, they're not buying the same securities. One likes particular stocks better than the others, particular bonds better than the others. So one manager earns 8%, one manager earns 12%. So the average for the world, the average performance overall is up 10% for the year. So what people conclude from that is that on average, all investment managers do not outperform the index. Well, that's true. All of them don't, but one of them did. So here, half of the managers, one, outperform the index, half of the managers, one, underperform the index. So you can't really look at the average and say, well, it doesn't make sense to look for a good manager because on average, they're not going to outperform. Yes, that's true. On average, they're not going to outperform, but some managers may outperform while other managers underperform. The trick is finding which are those that in the future are going to be able to continue to outperform. We can't conclude that there is not a potential edge to active management. Just taking that one step further and introducing expenses. Remember, I told you we had active managers, we have passive managers. If we take all of the fund managers in the world, active and passive, and we look overall at their returns, and then we try to compare that to the market index, they should not be the same. The market index, remember, does not include any fees or expenses. So therefore, the performance of all of the managers on average should be equal to the market index minus all of the aggregate fees and expenses for managing those portfolios. So by definition, yes, we should on average slightly underperform the index, but there are going to be some individual managers that do better, some that do worse. In most cases, the passive managers are going to come very close to the index. The active managers are going to have more variability. Some are going to be good, some are going to be not so good. So both mutual funds and ETFs are a type of investment company. They're regulated under the Investment Company Act of 1940 that's administered by the Securities and Exchange Commission. They're going to take this money from everybody. They're going to buy a pool of securities, and then they're going to determine on a periodic basis, actually in the case of an ETF daily, in the case of a mutual fund, they're also doing it daily, but they can't trade during the day. But every day they're going to look at the value of all the securities they own. They're going to subtract any liabilities they have. So for example, liabilities for operating expenses and those types of things. And then that's called the net asset value. They're going to divide that by the number of shares outstanding, and that's what we call the net asset value per share. So if you're buying directly from the mutual fund, that's the price that you would pay. It's the value of everything they own divided by the number of shares of securities in the fund. There are three main types of investment companies. There are open-ended investment companies. We also call those open-ended mutual funds. And the investment company is who you're going to transact with. So they're going to continuously issue new shares. And if you want to redeem your shares, they're going to be the ones that redeem the shares. So you're not actually buying on an exchange. You might buy through your brokerage company. So you might tell Schwab or Robinhood that you want to buy shares in a particular mutual fund. They're going to take your money. They're going to send it to the mutual fund company, and the mutual fund company is going to send shares back. But the transactions between the investors is actually through the mutual fund company. You're buying shares from the investment company. You're redeeming shares with the investment company. The other type of mutual fund is a closed-end investment company, also called a CEF or closed-end fund. It's a closed-end mutual fund. And once they issue shares initially, they don't issue new shares. So they issue shares once, Instead of buying and selling shares from the investment company, you're going to have to buy them, if you want them, from another investor. And so those are actually traded on the exchange, closed-end funds. You buy and sell shares from existing shareholders or with prospective shareholders on the stock exchange with each other. They're not adding new shares over time. Occasionally, they may downsize and redeem a bunch of shares because maybe the investment prospects are not that good. Typically, a closed-end investment company has a fairly narrow investment objective and often is not designed to be permanent. They might buy a portfolio of bonds and then over time plan on when those mature is closing up the company. In the extreme, we call that a unit investment trust. So if it's actually designed that it's going to liquidate at a particular point in time, then they typically use a structure called a unit investment trust, where they buy, say, a pool of bonds, and then as the bonds mature, they distribute that money to the individual investors. So all of these are ways of getting professional management through a diversified portfolio without having to buy the shares directly in the underlying companies. So as I mentioned, when you're buying this pool of investments, you can get income from interest, dividends, capital gains when you sell a security, also just the change in value from the underlying securities. You can also automatically reinvest those dividends, interest, and capital gains. So if you don't want to get them in cash, you can tell the investment company to reinvest them and give you more shares. But you're going to still have to pay tax on those gains because they are required to do that for tax purposes. They're going to distribute the gains to you. You're simply choosing to reinvest them in new shares in the fund. So I want to work through an example. It's going to be a little more detailed than what they show you in the book. So I want to show you how you calculate the net asset value and how you calculate the returns on an overall mutual fund that then apply to the individual investors. So the first thing is we're going to calculate a fund, the beginning net asset value based upon the investments they hold. We're going to calculate the ending net asset value. Then we're going to compute the returns, and then we're going to double check everything to make sure everything matches. So here's our portfolio. It's a small mutual fund. It only has $125,000 in assets. It holds 3 different types of stocks. So this is fairly concentrated, but I don't want to give you a portfolio of 500. It would make the spreadsheet not fit on the slide. So we're going to have 3 stocks and some cash. The total value of all of those securities is $125,000. At January 1st, the investment company has about $1,000 of liabilities. So the net asset value in total is $1,000. Oops, sorry about that. The net asset value in total is $124,000. There are 10,000 shares outstanding, so we have individual owners who hold 10,000 shares. You could hold 1, you could hold 1,000. You know, that's up to you how much you decide to invest. Sometimes they have a minimum. It can be in shares or dollar amount, typically in dollar amount. But most mutual funds today don't have minimums, some do. So we take the net asset value of $124,000. We divide by the number of shares outstanding. The net asset value is $12.40. So it's similar to a stock price. At that particular day, on January 1st, the value of each share in the mutual fund is $12.40. And so here's what happens after January 1st. So during the year, stock A and B pay a total of $2,400 in dividends. Later in the year, the mutual fund is going to pay those $2,400 out to their investors. They sold one of the stocks. They sold stock C, and they're going to sell it for $48 a share. It only cost them $40 a share. So they have a realized gain of $4,000. They're also, because of taxes, going to have to distribute that $4,000 before the end of the year to the other investors. During the year, they have fund expenses, so they're paying the management fees, they're paying any other administrative or operating costs. Those total about $1,200 per share. And then we're going to make our distribution. So we're going to distribute our dividends, we're going to distribute our realized gains. So we're going to distribute a total of $6,400. And then at the end of the year, we notice that the value of A and B have gone up. So the value of stock A is up by a total of $10,000, and the value of stock B is up by a total of $6,000. We call those unrealized gains. They're unrealized because we did not sell them. They've gone up in value, but we've not yet sold the stock. As a result, we are not required to distribute those gains. Those gains just stay in the fund until those stocks are actually sold. So here's what we look like at the end of the year. We still have 2 stocks remaining. We have more cash because we've got interest in dividends. We sold a stock. We haven't bought another one. We could with those proceeds, but we haven't done it before the end of the year. We total that up. It's $139,800. We subtract the liabilities. So our net asset value in total is now $138,800. And let's say we did not issue new shares or redeem new shares during the year. So we still have 10,000 shares outstanding. So our net asset value is now $13.88. Okay, so what types of returns did we earn during the year? So recall, we started out with an overall net asset value of $124,000 in the fund. We received $2,400 of dividends within the fund. If we divide that by the $124,000 starting value, we earned about 1.94% from the dividends that were accumulated during the year, and we're going to end up distributing those. We had, recall, $4,000 in gains on the one security C that we sold, divided by the beginning value of $124,000. So that works out to be a 3.23% gain. And then we had security A and B that went up by $10,000 and $6,000 respectively. So a total unrealized gain of $16,000 divided by $124,000 was 12.9% gain. And then we had expenses. $1,200 divided by $124,000 is a negative 0.97%. So if we add all of those up, 1.94, 3.23, 12.9 minus 0.97, we get an overall return of 17.1%. So you as the investor earned 17.1% during the year for your investment. Some of that was distributed to you in cash, but some is just accumulating within the fund. From a tax perspective, you're going to pay tax on about 1.94% and 3.23%. The rest of this, 12.9%, that's going to be deferred until a later year when you actually sell your shares or when the mutual fund sells shares A and B themselves. So here's another way of looking at it just to make sure that everything makes sense. So you recall that we started with a net asset value per share at the beginning of the year of $12.40. They're going to make distributions to us, both dividends and capital gains, of 64 cents per share. And the ending net asset value was $13.88. So if we calculate our total return, having an ending value of 13.88 minus the beginning value of 12.40, so we had a gain there. We add the distributions of 64 cents, and we divide all of that by the beginning value, then we're going to find out that we had overall exactly a 17.1% return. So it matches looking at it on an individual basis. All right. So it's a little bit more detailed than what the book shows. I'm not going to test you on this level of detail. You should know how to do this basic calculation here, the change in NAV per share plus the distributions per share to get the net asset value per share, and then then divided by the net asset value per share to get the overall return for the year. All right, I mentioned earlier that some mutual funds pay commissions. So it's fairly unusual today. Back 20 years ago, 30 years ago, the primary way that mutual funds were sold was not necessarily through Schwab or Robinhood. Robinhood didn't exist. Basically, there were mutual fund salesmen. They might have worked for brokerage companies, but they would actually look for investors in these funds. And so they would get paid a commission, in some cases as much as almost 6% of the purchase price of the fund. So if you were putting $100,000 into the mutual fund, that salesperson would get a $6,000 commission, which means only $94,000 of your money was actually going into the fund. And there were different ways of charging that commission. Sometimes they charged you when you made the investment initially. That was called a front-end sales load. In some cases, you didn't have to pay it immediately, but if you exited the fund before a certain number of years, then you paid it at the end. Class C, you paid a commission at the beginning and a commission at the end. These funds are much rarer today. Most mutual fund shares are no-load shares today, which means there are no commissions that are charged. There are some mutual funds that have what's called a 12B1 fee, which is typically a fairly small fee, maybe 0.25%, 25 basis points, or 1/4%. That helps pay for distribution, advertising, those types of things. But for the most part, there are not that many load funds out there, and you want to be very careful with them because, again, if you're buying a load fund, someone is getting paid a commission. They have an incentive to sell you that fund, so you want to be a little skeptical. And that's less of your money that's actually being invested. All right, so today I never buy load funds. I would never buy them for a client. There are so many mutual funds and ETFs out there today that are available that do not have a load, that they're, unless you find a manager who's really exceptional, and I've not found one yet I found some exceptional managers, but not one that's so exceptional that I'm willing to pay a sales load. So we do have, though, management fees and expenses. So you have to pay the manager. They have to have a salary for managing the investment. They have operating expenses, rent, computers, all of that stuff. And so every fund is going to have an expense ratio. And that's going to be the overall expenses that they need to operate the fund divided by the net asset value. In general, you want to try to find a fund that has a lower expense ratio. However, in some cases, the manager is doing a really, really good job, and so you might be willing to tolerate a higher expense ratio. So what's high? So historically, management fees for mutual funds overall used to be in the 1% to 2% range. Today, they're much lower than that, but anything around 1% and higher, that's pretty high. Anything 0.5% and lower is pretty low. It's going to vary, though. So you have an index fund like the S&P 500, the fee is extremely low, 0.03 or 0.04%. You're going to have others that are more actively managed, where there's a lot more work involved, there's a lot more buying and selling, and maybe it's 0.4 or 0.5 or 0.6%. So it's going to depend upon the level of activity, which also in turn is going to affect your taxes as well. I mentioned there's also sometimes a 12B1 fee. I avoid funds that have 12B1 fees. I'm not going to pay for their marketing cost. If they have some marketing cost, just include that, in my opinion, just in the regular expense ratio. I'm not going. This is a separate fee, so you would pay the overall expense ratio plus the 12B1 fee. You want to try and avoid those if you can. So everything we've talked about applies to mutual funds and exchange traded funds, except you're not buying and selling directly from the investment company. Instead, you're going to typically be buying and selling from the individual investors that have shares. They do issue new shares all the time. They do that through what's called an authorized participant, and I'll explain what that is in a minute. But an exchange traded fund is similar to a stock, but also similar to a traditional mutual fund. It's a pooled investment vehicle. It's a fund that trades on the stock exchange just like a stock. So it's diversified like a mutual fund for the most part, and it trades like a stock. So it's a blend. All right, you can trade it anytime during the trading day like a stock with other investors, or if you are a very wealthy investor, you can also get new shares from the investment company through the process. So typically, when they first started out, exchange traded funds were primarily passive and invested in large indices. And as a result, they tend to have lower expense ratios. Not always, but typically. They're also more tax efficient than most mutual funds, and I'll explain that in just a couple of minutes. So through an ETF, you can very quickly, anytime during the day, get exposure to a particular sector. So if at 2 p.m. you think, hey, I want to be in healthcare stocks, or I want to be in technology stocks today, you can get it instantaneously. You don't have to wait to buy and sell the shares at the end of the day or the next day from the mutual fund company. You can buy them immediately during market hours. So this is the process. So it's a little complicated. Again, this will not be on your test. But for those of you in particular that are going to go into financial planning and wealth management, you should understand the process and how it's a little different than a mutual fund. So you have the investment company, that's the ETF provider, and they're basically going to create the menu. They're going to say, this is how my ETF is going to invest, and on any particular day, each unit of the ETF, each share, is going to hold X shares of Apple, X shares of Microsoft. So they have a menu that says this is how you create a new unit. And so the way units are created is there for each ETFs, there's typically 10 to 30 authorized participants that are allowed to create the new shares. So the ETF provider doesn't directly create the shares. They do it through these authorized participants. So if you have, $10 million to invest, you can give it to the authorized participant through your broker, and then they will buy the underlying securities according to the ETF provider's menu, and then they will give those securities to the ETF, and the ETF will give them shares, and they give the shares to you. So the reason that they built it this way is it has a big tax advantage. The tax disadvantage for a mutual fund is that the shares are only created and redeemed by the investment company, and you can't go to them and give them the underlying securities and get shares. You have to, for a mutual fund, you have to give the mutual fund company the cash. That company has to then take the cash and buy the shares. We don't have any authorized participants in the mutual fund space. Now, that's fine on the purchase side. But let's say that some investors want to get out of a mutual fund. What the mutual fund company has to do is they have to raise the cash for those shareholders that are exiting. As a result, they have to sell some of the securities in the fund. And when they do that, they're going to have typically a gain because they've held them for a long time. Sometimes it's not a gain, but typically it's a gain. And that gain because it's owned or shared by all of the investors, they have to report it on everybody's tax return. So when somebody exits a mutual fund, any sales that are made to get the cash to pay those investors are then going to result in gains that all of the investors in the mutual fund, not just the exiting investors, but all of the investors have to pay taxes on those gains. Because of the way ETFs work, if somebody, a really big investor, wants to exit, then they don't actually distribute cash. They distribute the underlying securities effectively through the authorized participant to those investors, and then they cash out just their share. It does not result in a gain to all the remaining investors. So as a result, it's a complicated process, but as a result, ETFs, that structure is much more efficient than a traditional open-ended mutual fund. So let's talk about cost efficiency. So this compares mutual funds to ETFs. So if you look across all mutual funds that exist, this comes from the Investment Company Institute. They publish a book every year with data on this, and I'll put a link to this on Canvas if you want to take a look at their report that they issue. But on average, if you look at stocks or equities, the mutual funds that are invested in stocks, the average expense ratio is about 0.93%. So again, anything higher, that's going to be high. Anything lower is going to be lower, but some are going to be lower than others. If you look at ETFs, the average equity ETF has an expense ratio of almost half, 0.56%. Similar on bonds. If you look at bond mutual funds, the average expense ratio is 0.65%. There's more activity involved in trading bonds. For an ETF, 0.38%. So ETFs typically have lower expense ratios. Part of it is there are more passive ETFs than active ETFs, but the active ETF market is growing each year. So as I mentioned, ETFs are also more tax efficient. If you look at the need to distribute capital gains because some investors have left and the funds have made some sales, active mutual funds, 51% of them have distributed capital gains to their investors over the last 5 years. Active ETFs, only 13% because of the difference in the structure. Index ETFs distribute very little. So in general, ETFs are very tax efficient. You buy into them, you're going to have to pay taxes on a small percentage of the income unless you actually sell the ETF. Now, the level of tax efficiency is going to vary from ETF to ETF. If it's an index stock fund, it's going to be much more tax efficient than an indexed bond fund because the bond is going to have a higher level of current income and not as much as it's deferred through capital gains. So it's going to vary from fund to fund, but in general, ETFs are more tax efficient than mutual funds. All right, so let's summarize this. So I'm comparing a traditional mutual fund, that's an open-ended mutual fund, to an exchange-traded fund. They're both professionally managed. You can typically buy any amount of either, except some traditional mutual funds have a minimum, and they may have a minimum for different classes of shares. So, for example, VOO, if you want to buy a regular share that has a slightly higher expense ratio, there's no minimum, but if you want to buy what they call their advantage shares or their institutional shares, you typically have to have a higher level that you have to put in. As a result, you're going to get a slightly lower expense ratio. An ETF has no minimum. You can buy one share if you want. In the case of a traditional mutual fund, you're going to purchase or redeem those from the mutual fund company through a brokerage firm or directly, in some cases, with the mutual fund company at the end of any trading day. In the case of an ETF, you can buy and sell it through the stock exchange throughout the day. Typically, mutual funds are going to report their holdings every 6 months. They'll tell you their net asset value at the end of each day, but they're only going to tell you what they hold in their investments every 6 months. Sometimes they'll put it on their website monthly, but they're only required to tell you every 6 months, semi-annually. In the case of ETFs, the ETF company has to list the menu so that the authorized participants know what to buy and what to sell on a daily basis. So both their holdings and the NAV are disclosed daily. All right, so it's a little more transparent. It means that you can, in some cases, copy what ETFs are doing if you can get a hold of the menu on any particular day. Sometimes they're going to publish it on their website. Sometimes they're only going to give it directly to the authorized participants, but they will disclose the NAV in both cases on their websites at the end of each day. I'm not going to read through the detail here, but just remember ETFs are a little more tax efficient because you don't have capital gains that are generated that have to be distributed to everybody based upon just some of the investors getting out of the fund. So generally, ETFs are more tax efficient than mutual funds. So now let's talk about different types, and we're not going to talk about every single variation, but there are money market mutual funds, money market ETFs, so they're investing in very short-term treasury bills, CDs, and other things. So it's like having a cash account at the bank, but these money market funds typically pay a higher rate of interest. So for example, right now, you can buy a Schwab money market mutual fund that's paying about 3.5%, much higher than what you can get in the bank. It's fairly safe in that it's invested in very short-term government investments. You don't have any very much expenses. Expenses are very low. They trade at a constant $1 net asset value, so it doesn't really fluctuate in value because they're just investing in treasury bills and CDs. You can cash these out in one day. So again, a mutual fund trades at the end of the day. So you can buy, if you put in an order to buy the Schwab Money Market Fund at 2 p.m., you'll give them the money. They'll actually buy it for you at 4 p.m. If you want the money back the next day, you can put in a sell order, and at 4 p.m. they'll sell the shares. And so 2 days from now, you have your money back. So you can typically cash out with one additional day to get your cash. And they have taxable and both tax-exempt versions of money market funds. So again, any type of investment you can make individually, buying treasury bills, buying CDs, you can do it through a mutual fund or ETF. This is just a sample of the variety of stock funds that are available, both mutual funds and ETFs. You can buy growth funds, large cap funds, mid cap funds. You can buy value funds. You can buy income funds that tend to pay a higher level of dividends. You can buy a fund that invests in a particular sector like technology or a broad market index. You can buy one that's focused on an international index, an individual country. You can buy, for example, I've owned for the last couple of years a Korea ETF, and Korea is up more than 100% over the last couple of years. So you can buy very concentrated funds as well as very diversified funds. You can buy thematic funds. Thematic funds might be in AI-related stocks or gold mining stocks or robotic stocks. So pretty much any type of investment you want, you can find a fund that'll do it. There are balanced funds. So instead of deciding to, let's say you want to decide that you want 80% of your portfolio in stocks and 20% in bonds, you can buy several ETFs to invest the 80% in stocks and several ETFs to buy the 20% in bonds, or you'll find a balanced fund where the investor's objective is to put 80% in stocks and 20% in bonds. So they're basically doing that for you. So you can find balanced funds for any percentage you want. You want to put 70% in stocks and 30% in bonds. You can find an investment manager that has a mutual fund or an ETF that will do that for you, so you don't have to pick the individual funds. In my opinion, I like to buy best in class, so I don't like to buy balanced funds. I prefer to buy the individual stock funds and the individual bond funds so I can pick the best managers in each of those asset classes. It's rarer to find a company that can do a great job at both. Same thing, you can buy an asset allocation fund that changes the percentage as you age. So, for example, you can buy, sometimes they call these lifestyle or life cycle funds, where you can buy a 2060 fund. So that what that means is it's designed for people that are going to retire in 2060. And so because that's still, 34 years in the future, it might be heavily invested in stocks today. But then over time, as you get closer to retirement, it's going to lower the allocation to stocks, increase the allocation to bonds. They also may be doing tactical asset allocation, where they're going to move between different asset classes a little more frequently versus over time, but those funds exist as well. The second type, or the one of those types that I just talked about, is called the life cycle fund. So that's where they're basically going to typically be more aggressive in the early years and then be less aggressive as you near retirement. That's a version of an asset allocation fund. On the bond side, there are many variations of bond funds out there. Just like with a stock fund, they're professionally managed. They're going to fluctuate in value because, as we saw last week, bonds fluctuate in value as interest rates go up and down, but they're professionally managed. They have regular income. Unless it's a unit investment trust, they don't have a maturity date. So as some bonds mature, they'll take that money and buy new bonds. So you're always invested in bonds. You don't have to worry about reinvesting the money yourself. The bond fund is going to do that to you, or do that for you. Types of bond funds: U.S. government, municipals, corporate bonds, high yield bonds, emerging market bond funds, pretty much anything you want. You can buy a short-term fund, invest only in short-term bonds, a long-term bond fund, or an intermediate-term bond fund, depending upon what your investment objective is. Okay, so now we've talked about the different types of mutual funds and ETFs, how they work in general, mathematically, etc. Now we want to talk about the criteria that you want to look at, the metrics to decide which are the better funds. The best source of information for this is an organization called Morningstar. Your book mentioned you can get a free account there. I think you still can get a free account, but a lot of the data you can't get unless you pay for it. It can cost, depends on your type of subscription. I think for an individual investor, they typically charge about $250 a year. I have a higher level. I pay about $250 a month to get access to a slightly better data set. But if you can get a free version there, definitely try it out. But there are other free choices out there. So Yahoo Finance, for example, you can get mutual fund performance data. You can go to the individual ETF providers like Vanguard and Fidelity and other mutual fund companies to get data directly from their website as well. I like Morningstar because it gathers information on 10,000 funds and then puts it in a standard format. This is a Morningstar investment report for the Vanguard 500 Index Admiral Fund. Admiral is they have different levels. They have a Admiral Fund, they have an institutional fund, they have different minimums. This one has a minimum of only $3,000. This one is a mutual fund. I'm going to post this and a couple of other samples of ETF reports from Morningstar along with this video, so you can take a look at the detail here. I know you can't really see it on the slide on your computer, but I'm going to post a PDF so that you'll have this to look at. But this pretty much in one page summarizes the most important things you need to know about the mutual fund. And I'm going to cover the individual items a little bit more on subsequent slides, but just a few things to look at. One of the things that Morningstar does is they compare the funds with other funds and they evaluate it. So a gold level fund has a very high rating. They also rate by the number of stars, the highest being 5 stars. They rate this fund as 4 stars, which is fairly high in the Morningstar rating system. They tell you how this fund is doing against different indices. In most cases, they're going to use as the standard index the S&P 500. This is an S&P 500 fund, so they definitely use the S&P 500 index for comparison. And then they also have a category index that they compare to as well. In this case, they're comparing it here to other S&P 500 funds. Here they're comparing to all large cap funds. Down here in the middle, you'll see this 9 square box. This box is the style of the fund. So down, you can't see it very well here, but it's large cap, mid cap, small cap. So this is a stock fund, so they're looking at the size of the companies that are being purchased by the fund. In this case, the shaded box is large cap, so you're only buying large companies if you're buying into this fund. And then across the top, it's value, blend, and growth. Value would be funds that are typically trading at low prices relative to their earnings and other metrics. Growth funds are those that are tending to sell at higher prices because they have higher future growth rates. Blend, or sometimes called core, is in the middle. So they're just buying all 500 stocks. Some of those are going to be growth stocks, some are going to be value stocks, and everything in between. So this is what we call a blend, or sometimes a core fund. I don't like to use, some people use the term balanced, but the problem is that usually involves stocks and bonds, so I'm going to call it blend or core. All right. Then there's basically they show each year over the last 10 years what the return has been, what the net asset value has been. They'll tell you a little bit about how it's done relative to its category. Over on the left, they give you what the return has been for the last 1 year, 3 years, 5 years, and 10 years. And they'll compare that to the index. So you'll notice here, it's in very small print, but this says that this Vanguard 500 Index Mutual Fund has been slightly below 0.05% below the return of the index. So just like I showed you earlier, that should be our expectation. It's very close to the overall S&P 500 index, but you have to pay Vanguard a fee to manage the fund. And so your return is going to be very slightly less than the S&P 500 because of that. All right, so we're going to switch and talk about quantitative and qualitative metrics to look at. So one of the things we look at is what's the return been over various periods. So what I just showed you, how did they do over the last year, the last 5 years, the last 10 years? Some funds have been around more than 10 years, so you can look longer, 15 years, 20 years. One of the things that's on that report is the expense ratio. The expense ratio for this fund is, I believe, 0.04%. And that is here somewhere. Here it is, right down here. Gross expense ratio, 0.04%. Practically nothing. So very low expense ratio. So lower cost means you get to keep more of the return. On the other hand, if you have an actively managed fund, they're not going to manage it for you and buy and sell and do all the analysis that's necessary for a fee of 0.04%. So those funds are going to cost you 0.6, 0.7, 0.8, maybe 1%. In some cases, even higher than 1%. They're also going to tell you in these reports their turnover ratio, so how frequently they buy and sell stocks during the year. The reason that's important is it has a tax impact. The higher the turnover, the more realized gains you're going to have, so the higher your taxes are going to be currently versus in the future when you sell the fund. So depending on where you're holding this, if you're holding it in an IRA, you're not really concerned about turnover. But if you're holding it in a taxable account, a higher turnover fund is going to mean probably higher taxes, higher distributions. So you may want to avoid those funds, or maybe not. If they're doing a really good job of trading securities, maybe you can tolerate that turnover. Two really important measures are alpha and beta. So alpha is the excess return relative to the benchmark. So we saw in this case, it was 0.05%. So their alpha is slightly negative, but that's okay. They're very close to the benchmark. If that's positive, that means they're actually generating alpha. They're generating a positive return in excess of the benchmark. Beta is how sensitive the portfolio is to the market. So you'll learn about this in your other finance classes as well. The market has a beta of 1 by definition. This particular stock fund is designed to follow the S&P 500, which pretty much comprises the market. So not surprisingly, this fund has a beta of 1. If you buy a fund that has a beta of 1.2, that means it's going to be a little more volatile than the market. If you buy a fund that has a beta of 0.8, that means it's going to be less volatile than the market. So that's a measure of risk. The Sharpe ratio, which you'll also learn about in your investments class, is a nice measure because it combines the return and the risk. So what they do is they take the risk-adjusted return, so they calculate the excess return over treasury bills. How much higher return does the fund get relative to treasury bills? And then they divide by the standard deviation of the excess returns or returns. So you're getting a measure of return relative to risk. This is going to vary over time, depending upon whether you're measuring it on over 1 year or 3 years or 5 years. Typically, we measure it over 3 years. In general, a higher Sharpe ratio means you're getting a higher return relative to risk. So it's really useful to comparing two similar funds. So if you're looking at two different mid-cap stock funds, then you would measure the Sharpe ratio for the same time period and compare the two funds. It'll tell you which one is giving you a higher return relative to the risk of that individual fund. A measure that's similar to the alpha is the tracking error, but it's the volatility. So it looks at how volatile the returns are for a fund versus the benchmark. So a high level of tracking error would basically mean they're not following the benchmark very well. They have more volatility. If you're really trying to match the market index, then you want to buy a fund that has a lower tracking error. This one is not shown. The next one's not shown in the Morningstar report that I just showed you. It's the upside downside capture. If you get the more advanced Morningstar data, you can get this one. So it's something I look at. So they look at over, say, a 5-year period, when the market's been up, how much of the upside do they capture? Ideally, you want 100% or more. When the market's been down, they look at how much of the downside they capture. You want that to be 100% or less. So you want it to perform better in up markets than down markets. But unfortunately, they don't show this on the general report, but it is something that you can get if you have a more extensive database. Another one similar to tracking error is R-squared. And so that's where they run a regression of the returns on the fund relative to the benchmark. And R-squared of 1 or 100% would basically mean it matches the benchmark. If the R-squared is less than 1, then it doesn't quite match the benchmark. The maximum you can have on an R squared is 1, by the way. The maximum drawdown is looking at from a high level, the high net asset value to the low, what's the maximum loss that a fund has incurred during a particular period. Also not in the general report, but you can get this typically from the mutual fund company or from a more detailed subscription to data. Those are all quantitative factors. You also want to look at qualitative factors. First is, does it match your investment objective? So what's the investment objective of this particular fund? And is that exposure that you want to have? So you want to make sure it matches the investment objective for whatever asset class you're choosing the fund for. You want to look at the fund manager. How much experience do they have? How long have they been around? David Lynch was a very famous Fidelity fund manager. He was managing a particular Fidelity fund for decades. Very experienced, very well respected. When he left, other managers took over. They were less experienced. Certainly he had trained them over time, so they were ready to do that. And that particular fund, the Magellan Fund, has continued to do well. But it matters who the manager is, because if fund has done really well the last 5 years and you invest in it, but it's a new manager, they may not be as good as the previous manager. This is not as important for index funds. So an S&P 500 index fund, they're just going to buy those 500 stocks. They're not picking stocks per se. Then the fund manager is not as important, but the company is. You want to make sure it's not a brand new company that hasn't been around very long, doesn't have a good reputation. You want to make sure that they're going to be managing the account properly, servicing the account properly. So the longer their experience, the better. You want to make sure that the investment philosophy of the manager matches the objective. If they're a value manager, you want to make sure they truly believe in that. You read what they've written about. You look at other funds that they've managed, and you want to make sure that it matches your objective for this particular fund. You want to look at the portfolio concentration. So that's, again, a more concentrated portfolio that has a higher turnover. It's going to have higher taxes, higher risks. So those are some non-qualitative things you can look at, although there are quantitative measures that help us with those. How transparent are they? How well do they report to you on a semi-annual basis? What information is available on their website? Do they give us information on the portfolio monthly instead of semi-annually on a voluntary basis? The more transparent a company is, the better for us in general. Although if it's a really active manager where they're investing in a portfolio of only 30, you would expect they're not going to be as transparent, because they don't want people free riding and just going to the website every day to see what they're buying and selling. So you're probably going to get information a little less frequently for an active fund, and that's okay. You want to look at the parent company. Who owns them? What's their rating by Morningstar? Morningstar not only evaluates the individual funds, but they also rate the company. So you want to look at the ratings for both the company as well as the particular fund that you're going to invest in. And there are other raters out there. Morningstar is the one that I prefer. So we have to remember tax considerations. If we're going to be putting these funds in a taxable account, we want to recognize that ETFs are going to be a little more efficient. Index mutual funds are also pretty efficient, so that's okay to put in a taxable account. We also want to consider asset location. So REITs, as I mentioned, are the least tax efficient of funds because they're going to distribute ordinary income to you every year. And so if you're going to buy a REIT, you're best off buying that in a tax-deferred account or a tax-free account. You can buy it in a taxable account. You just have to recognize you're going to have to pay taxes on that income on an annual basis. You have to just keep in mind that there's embedded capital gains. So over time, these mutual funds have bought stocks. Maybe you're buying the fund today, but the stocks they're holding, they may have bought some of them 10 years ago. And so there's this unrealized capital gain that's embedded there that when they sell those stocks, they're going to distribute to you. And so you want to be aware that that could affect your ultimate return. You may have to pay taxes on gains that didn't really accrue to you. They accrued to other people over time. That's just the nature of the way these things are structured. So let me give you an example. So this is comparing two Vanguard funds. So the one I showed you the Morningstar report on is the Vanguard Admiral S&P 500 fund. That's the ticker symbol. Typically, mutual funds have a 5-letter ticker symbol. ETFs have 3 or 4-letter ticker symbols. So this is the Vanguard Mutual Fund that follows the S&P 500, one of them, VFIAX, versus a Vanguard ETF that follows the S&P 500, and that ticker symbol is VOO. So I'm going to use data from Morningstar through February 28th. So I basically took those two reports, fed them into some software to do a comparison of the funds with each other. So just some information. The mutual fund has been around since 2000. There's been other index funds from Vanguard that have been around for a lot longer. This particular one has been around for 26 years. In total, the investments in the fund are $1.51 trillion. A lot of people invested in this fund. This fund has a very low expense ratio. If you want to buy it, you have to have a minimum amount to invest initially of $3,000. After that, you can buy 1,000 more each time or 500 more each time. There's no minimum after that. But initially, to buy into this fund, you need to put in $3,000. Has a very high rating, has very low turnover. They're just buying the S&P 500, very little buying and selling of securities. They pay dividends of about 1% per year. So you're going to have very little in terms of realized capital gains. VOO, on the other hand, is an ETF. It's only been around 16 years, which is actually long for an ETF. They manage less than $1 trillion, about $800 billion. There's no minimum investment. You can buy one share through Robinhood. You can actually buy fractional shares if you want, but one share is small enough. The expense ratio is slightly lower. It's a little easier to manage an ETF than a mutual fund. So these two funds basically have the same manager. They're run by the same company, but ETFs are a little more efficient. They're not as expensive to manage, to administer, so slightly cheaper. Same turnover, same Morningstar rating, same overall yield in terms of what they're paying out as distributions. Oh, I should note down here at the bottom. So they have an R squared of 100. That basically means they meet the S&P 500 pretty closely. They match the index. They actually hold 503 stocks. We call it the S&P 500, but S&P actually right now there's 503 stocks in the index. They own all of them. These funds are both weighted identically. They own the same percentage of the underlying securities because that's what they're designed to do, to match the index. The team that's managing them has been around for 8 years on average. So it's a team of people that are managing these, and it's the same team managing both of these funds. Okay, this is just showing you the factors we're going to look at. So this is looking at the returns versus the S&P 500. So the blue bar is the return for the mutual fund from Vanguard. The green bar is the return from the ETF from Vanguard. And the brown bar is what the index return is. So remember, mutual funds and ETFs are going to have expenses. So they're going to be slightly lower than the index return, but they should be pretty close if they have a low tracking error, okay? They're doing exactly what they're designed to do. And so in this case, you'll notice that the mutual fund is a very slightly lower return than the ETF. The ETF has a very slightly lower return than the index. They're doing what they're designed to do. The difference is in the expenses. Okay. The ETF is slightly less expensive than the mutual fund, very slightly. So different measures, alpha, they have very low negative alpha, so they're slightly underperforming the index. This looks at over 3 years, 5 years, 10 years. That's the data I showed you earlier in the Morningstar report. They both have a beta of 1, similar to the R-squared, which is 100. They basically match the performance of the index over the last 3 years. They have a similar Sharpe ratio, so they're indistinguishable. No matter what time period you look at, these funds have a almost exactly equal return relative to risk. Okay, so that's a decent Sharpe ratio to have. 0.7, 3.8, 1.37. They're giving you a good return relative to the risk you're taking on. This is another measure of risk, the standard deviation of returns. Identical. The tracking error, very, very close. The ETF being just a slightly closer because lower expense ratio. Unfortunately, we don't have on that report the up and down capture or the market or the maximum drawdown, so I'm not listing that here. Overall, expense ratio for the mutual fund, 0.04%, very, very cheap. ETF, 0.03%, just a tiny bit cheaper. Both have a turnover of 2%. Both are reasonably tax efficient. So at the back of the report, it's not on the first page. There's actually a little bit going on to the second page of the Morningstar report, and they will tell you if what your return would be after paying your taxes, just on the dividends or assuming you sold the shares. And so you can compare those to their overall return. They only do this on a calendar year basis, so it's not really apples to apples comparing to the returns I gave you earlier. It's slightly different, but these are fairly tax efficient funds. The mutual fund does have some embedded capital gains because they've owned a lot of these shares, like Apple shares, for 26 years. There's some embedded capital gains there. If they were to sell everything that they hold, then 29% of the value of the portfolio would be distributed to the owners at a gain. So there is some capital gains exposure. We don't really worry about that. I'm listing it here, but we don't really worry about that here for an S&P 500 index fund because we know they're not going to sell it. It's designed to hold the S&P 500 index forever with very minor sales over time. You get to choose when you pay taxes, and that's when you sell the overall fund. The Morningstar does not calculate the capital gains exposure for an ETF because of the different structure. There is some exposure there. The ETF has not been around as long, but it has some embedded capital gains as well. Again, you're going to choose when to pay them then, though, because you're going to choose when you sell the ETF. So qualitative structures, factors you look at. This is the same team that's managing both of these. So in this case, no matter which one you buy, you're getting the same people managing it. It's a good parent company. You have slightly more transparency with the ETF, very slightly. You pretty much know what's in the S&P 500 structure. You can buy any number of shares of VOO. You do have a minimum of 3,000 for the mutual fund. If you want to buy this anytime during the day, you would buy the ETF. If you're willing to wait to the end of the day, you would buy the mutual fund. My opinion, unless you have a restriction, you're generally better off buying the ETF in almost all cases. There are going to be some mutual funds for which there is not an equivalent ETF. There are the Schmid Value Fund is a fund I like. I know Bill Schmid. I know his son Cole that runs the fund. It's a great fund. They only offer a mutual fund. They don't offer an ETF. So if I want to invest in that fund, and I have in the past, then I have to buy the mutual fund. I can't buy an ETF. So if there's a particular manager that I like and he doesn't have an ETF, I will buy the mutual fund. So I'm more likely to buy a mutual fund in the actively managed space, because in the index space, like the S&P 500, we can see right here there's an ETF that's just as good and run by the same manager as the mutual fund. So if you have a choice, buy the ETF. Slightly, I know it's a very small amount, but slightly better performance, and you can sell it immediately if you ever wanted to. The only reason you might buy the mutual fund is because you have to. So let's say that you are working for a company that has a 401k plan. Right now, you can't buy ETFs in your 401k plan. So typically, most companies for their 401k plans use Fidelity or Vanguard. And so you have to buy a Fidelity or Vanguard mutual fund in your ETF. In that case, this is a great index fund to put in your 401k plan if your company is using Vanguard. If they're using Fidelity. Fidelity also has an S&P 500 index fund you can buy. So in some cases, you're not going to have a choice. In some of your retirement accounts, like your 401k plan, you may have to buy the mutual fund. But if it's an IRA, then you can buy what you want. ETF versus mutual fund, generally better off buying the ETF if they're the same on the other factors. Okay, so this is, we talked about bonds last time, but I want to talk a little bit specifically about some other criteria you want to look at for bond funds. So we just analyzed 2 stock funds. For bond funds, there are some slightly different metrics that you're going to want to look at, but very similar to stocks. There are mutual funds and there are ETFs investing in bonds. So what do you want to look at for bond funds in particular? So the SEC yield, we also calculate this for stock funds, but it's more important for bond funds. It's basically measuring the yield you're getting on that investment over a 30-day period, standardized on an annualized basis. So it tells you in average what your income is going to be from the fund. That's something the SEC mandates. More importantly, you're going to want to look at the yield to maturity. That's the percentage return you're going to get on an annual basis if you hold the bonds to maturity. So it looks at the long-term potential. The distribution yield looks at the actual dividends they paid over the last 12 months and what that is relative to the value of the fund. So a higher distribution yield means higher earnings coming from the fund on an annual basis. With bonds, we noticed last time that bonds are sensitive to interest rate changes. The longer a bond is, the more sensitive it is to interest rate changes. So a bond with a 30 years to maturity is going to have a lot of interest rate sensitivity. As bonds change, the price is going to go up and down a lot. If a bond is going to mature in only 5 years, then it's going to be less volatile than a 30-year bond. As interest rates change, it's going to go up and down, but not as much. A treasury bill that's for 30 days or 60 days or 90 days is not going to be that sensitive at all. So the longer the duration, which is, I'm not going to go through how you calculate duration today, but the duration is related to the maturity, okay? It's a mathematical measure of the weighted average time for you to get cash flows from that bond. It considers the interest you're going to get and it considers the principal at the end. So a 10-year bond might have a duration of 9 years. It means on average, you're getting your cash back between interest and principal in about 9 years. But the higher the duration, the higher the interest rate sensitivity. So if you want to avoid fluctuations, then you may want to buy a bond fund with a slightly lower duration. It will be less sensitive to interest rate changes. Another way of looking at that is to look at the average maturity as an alternative to the mathematical duration calculation. You want to look at the credit quality of the underlying bonds. Does it own primarily bonds that are AAA rated, or are they BBB rated, or are they high yield down in the C and D category? So you can look on the Morningstar report to see how many bonds or what percent of bonds they have in each rating category. Similar to stocks funds, we can look at the standard deviation of returns. We can also look at the downside and upside capture ratios. Just like with stock funds, we want to look at the total return over different periods of time. We want to calculate a Sharpe ratio. The return relative to risk, higher is better than lower if you're comparing two funds. You want to keep your expenses lower, okay? So generally lower expense ratio is going to mean a higher return that you get to keep. You also, similar to stock funds, want to look at the turnover ratio. How often are they changing out the bonds that they're holding, and what are the tax implications for that? Qualitative factors, very similar to equity funds. You want to look at the objective of the fund. Does it match what you want to do? How long has the manager been around? How big is the fund? Are they able to buy things efficiently? And then what's the tax treatment? If you're looking to buy a bond investment for a taxable account and you're in a very high tax bracket, you may want to look at a fund that's invested in municipal bonds versus other types of bonds. So some overall thoughts, all right? You have a choice in some cases between investing in ETFs and mutual funds. When you have a choice, in general, ETFs are going to be the most efficient, particularly if they're tracking an index. If you're looking to hire a skilled manager, so for example, you might be investing in a segment of the market that you think is less efficient. And in my opinion, the small cap segment of the market is less efficient. Large stocks like Meta and Amazon, there are dozens of analysts that are following them, issuing reports on the company. Everybody knows what's going on. The market is fairly efficient in pricing those. It's hard to find an edge. On the other hand, in the small cap space, there are not as many analysts following those companies. They may not be as well known. So there's an opportunity there for a skilled manager to start a fund and generate perhaps some excess returns. And so if you're looking for an area where you think a skilled manager can get an edge, in my opinion, those are things like small cap, emerging markets, or particular sectors like technology or hospitality, where there are expert managers that really know that space. Then you may want to use a mutual fund. If you're investing in a tax-advantaged account, a mutual fund is fine versus an ETF because you don't care so much about the tax strategy. You want to look then at things like comparisons of the expense ratio. So general rule for me today is most of my investments are in ETFs. I still personally buy some individual stocks, but for the most part, mine are in ETFs, but I do hold some mutual funds in particular segments of the market. So we talked about these last week, but I do want to talk about them again briefly because real estate investment trusts are very similar to mutual funds and ETFs. It's a slightly different legal structure, but it works pretty much the same way. Instead of buying real estate directly, buying commercial property and renting it out as office space, or buying homes and renting them out, or apartment buildings and renting them out, you can get the same type of exposure by investing through a real estate investment trust, which is a pooled investment vehicle like a mutual fund or an ETF. You give your money to the real estate investment trust. They either buy the individual real estate properties and manage them, or they invest in other property management companies. So you can pretty much get it in any sector. You can get a diversified real estate investment trust. This is the National Association of Real Estate Investment Trust. If you do a search for NAREIT, you can go to their website and they'll give you a list of all of the real estate investment trust in different categories: office, industrial, retail, residential, healthcare, self-storage, timber, infrastructure, data centers. Pretty much any type of real estate you want to own, you can own it through a real estate investment trust. So why do this? It's liquid. There are both public and private real estate investment trusts. The public real estate investment trusts trade on the stock exchange just like an ETF. So you buy and sell the shares on the stock exchange like an ETF. If it's a private REIT, then you buy and sell directly from the REIT, and it's harder to sell. So if you want to cash out, they're going to have to sell some properties to raise the cash, or they need to find some other investors to come in. It's easier to do it on the exchange. I recommend public REITs. In some cases, I've had some clients that have been in the real estate business, have had private REITs, but you have to understand that they're not going to be as liquid as a public REIT, where you can get out whenever you want or buy whenever you want. But they give you diversification, similar to ETFs and mutual funds. They generate a high level of income because they have to distribute all of the operating income each year. You're getting professional management, so you don't have to worry about collecting the rent from your people that are renting the office space or the homes or the apartments from you. Someone is doing that for you. It's readily accessible through any brokerage account. They have SEC reporting requirements, so every quarter you're going to get reports on how they're doing. Once a year they're going to be audited. They typically have a very low minimum investment. So if you want to buy an office building, you might need $1 million or more. If you want to buy a single family home that you're going to rent, that's going to cost you hundreds of thousands of dollars. In the case of a REIT, if you want to put $1,000 in real estate, you can put $1,000 of real estate. The nice thing about having some real estate in your portfolio is it's a good hedge against inflation. As inflation goes up, rents go up, property values go up. So this is one example of a very diversified REIT. I happen to own this one. This is the Vanguard Real Estate ETF. The ETF is invested in individual REITs, okay? So instead of buying the REITs directly, you buy the ETF, and then the ETF is buying hotel REITs, retail REITs, single-family home REITs, data center REITs, extremely diversified, so very broad exposure. Office REITs did particularly poorly the last 10 years. So post-COVID or during COVID, people working from home, office prices plummeted. So if you were buying just that sector, you had a high degree of volatility. Starting to come back. We don't know what the long-term perspective is, though. And so, in my opinion, it's generally better to be a little more diversified. In some cases, if you're a more aggressive investor, you may want to get into individual segments. Right now, I'm primarily heavily diversified through this real estate investment trust or ETF invested in REITs. I used to own directly the last couple of years some data center REITs, but now those did really well. They're not doing as well right now. So I still own them, but I own them indirectly through this one, because this one has data centers for about 9%. I also like that they have telecom towers and those types of things. So very diversified. All right, so we are done, and I will see you again live in class next week, and see you during the week during office hours. Have a great week.